Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Dave Kranzler of Investment Research Dynamics, located at investmentresearchdynamics.com. And I got to tell you, there are some crazy things happening in the silver market right now. From stackers wiping out the bullion dealers of their inventory, to the so-called Reddit traders thinking they could take on the cartel, to the cartel giving the retail day traders exactly 1 day of laughs before bringing the hammer. Wow, you could say that silver's been a roller coaster ride over the last few days, but that would be a major understatement. But hey, if we're going to be on this roller coaster, we need somebody sitting beside us who's not going to puke his guts out, but rather somebody who can appreciate the chaos and help even calm our fears about it. Now, I can't think of a better person I'd like to have on this ride beside me than Dave Kranzler. So wish us luck as we go over the first drop. Dave, I'd like to thank you for joining us again on Silver Doctors.
Thanks, Paul. It's good to be back.
Now, Dave, I'm not going to rant. I'm not going to go off on some wild tangent here, but I've got to share some emotions that I've had over the last several days with you, Dave. Because last Wednesday I was like, oh, great, there's this grassroots push, this Wall Street's bets thing. What's going on? Is the little guy finally standing up? And then later on that afternoon, somebody updated that Reddit post, and it looked to me like they were turning it to a pump for First Majestic Silver. And I was like, oh, my goodness, there's the first red flag. And it's like that song, one bourbon, one scotch, one beer, where he goes, everybody funny. Now you funny too. And then all of a sudden everybody gets bullish, and everybody's just super, super bullish. And I'm like, oh my goodness, here comes another red flag. And then, you get yesterday, the CFTC is releasing statements and the mainstream propaganda is going out on it. And then I get the hate mail for writing this article saying, hey, watch out, there could be an imminent price crash coming because you're really going to go up against cartel like this. So I have just been on this emotional roller coaster over the last week, Dave. And quite frankly, I'm exhausted about it. So just in general, what are your thoughts on silver over the last week? What are your feelings about it? Anything you want to share just about the silver market and what you've been experiencing over this last week, Dave?
Do I have to quote George Thorogood?
Everybody funny.
I really did not want the Reddit crowd to get involved in the precious metals like this, because I knew I knew there was a risk that it would be short-lived. And, I don't know if, 1 day makes a trend, but, silver dollar-wise is down more now than it was up yesterday. So, and I think what they were trying to do is short squeeze some of the stocks that have a high short interest in silver. Silver miners like First Majestic being the poster card example. And the reason why these short squeezes are working, in stocks like GameStop, is because the short interest is in excess of the float from naked shorting by hedge funds. And there's a reason why hedge funds were short stocks like GameStop, because it was a POS company that was headed eventually to bankruptcy. The thing was trading under 5 earlier this year, or, in the middle of 2020. So, to me, no one really knows for sure what's going on behind Wall Street Bets, who's behind it. It's a lot of anonymity there. And I think there's, unfortunately, my cynical side is saying, Wall Street Bet is a pump and dump gig, and it was designed to suck in the retail crowd, because that's who is always the last dumping ground for bubbles. Is you got to get the retail money in there, because you need someone to sell it to, right? And we saw that in 1999, early 2000. Same type of dynamic was going on back then. You had these chat boards. And you had, guys in there cheerleading stocks, and it was all retail driven, and the retail investors were the last leg up in late 1999. And it turns out they were the stool pigeons because when the music stopped, they were left standing. Everyone else had chairs. And that's what my fear is about Wall Street Bets. Now, I don't know for sure. I can't prove it, but it sure feels like it. Especially when you look at what's going on in stocks like GameStop today. First Majestic now is down 22%, the stock. So, I'm not sure why the short interest is where it is in First Majestic. I think it was in the high 20% of float, mid 20% afloat, which is high, but it's not, let's engineer a short squeeze high. And I have a feeling that there's, First Majestic might be used in pair trades by hedge funds, um, because it's as it's a premier silver mining company, and then one of the few pure silver mining companies in the world. And we don't need the precious metals community doesn't need a bunch of pump and dumpers to try and create short squeezes in the precious metals market in order to make money in this market, because the precious metals sector, including stocks like First Majestic, are fundamentally very undervalued. And silver is probably the cheapest investment asset in the world right now. And yeah, there's a lot of heavy manipulation going on in the paper market, COMEX futures and LBMA forwards, etc. But we've been dealing with that for the last 20 years. And measuring from the last 20 years, gold has been the best investment. If you start, I think, mid 2000, which is really kind of when the secular bull market started, the first cycle of the secular bull market. So so my worry was when I saw the Reddit idiots getting involved in this stuff was that, oh great, they're going to push it up, they're going to realize they can't squeeze it, and the banks are going to let whoever wants to dabble in the futures market try it out, get long, and then they're going to slam the market, and that's what we're seeing today.
So Dave, explain this a little bit more for viewers and listeners. So, everybody's expecting this epic short squeeze that's going to break the banks. We're going to stick it to the banks this time. But what exactly does that mean? But more importantly to what that means, I mean, even with the best possible scenario, isn't the COMEX and the SLV and all these things, aren't they just set up where you can't really break the banks anyway? So just talk to us about what this epic short squeeze means, if it's even possible, and any escapes that these institutional paper silver product pumping places like COMEX and SLV have.
I mean, let's just use the COMEX as an example, because that's the best example. And if you go to the weekly commitment of trader reports, which are produced by the banks themselves and then sent to the CFTC, so who knows what the degree of integrity is of the actual numbers. JP Morgan has been caught with its hand in the cookie jar, putting trades that belonged in its house account into the other reportables account for people who have seen the COT report before. I think it was 2012 or something like that when it happened. They were wrist slapped a $650,000 fine by the CFTC for it. So, but the COMEX it's not a gold trading market. It's not a physical gold bullion trading market, as you know. It's a paper. It's a futures. It's a gold derivatives trading market, and that's what it was set up. That's what it was designed for after Nixon closed the gold window. So, I mean, you're not going to squeeze the banks, even though they have absurd short positions in COMEX, net short positions in COMEX gold and silver futures, because they can just keep printing new contracts. As new buyers come in, they just keep printing more contracts, and I call it feeding the ducks. Because it's no different than the Fed's printing press. Oh, we got more demand for silver futures here. Let's just print some more paper. If you look at, and I haven't run the numbers in quite some time, but let's just say the open interest in, I don't know, silver contracts is where 200,000, 180,000 contracts or whatever. Well, if you multiply that out by 5,000 ounces of silver, because and I'm talking just the big contracts, each contract represents 5,000 ounces of silver, and if you multiply that out, you'll find that the open interest in paper COMEX paper silver contracts far exceeds the amount of underlying physical bars that there would be available to deliver. And so the thing is, the only way you're going to squeeze the banks in this game, and it's going to happen eventually. And the retail guys on Wall Street bets, they don't have the kind of capital it takes to go in and buy big COMEX contracts and take delivery, right? So, but what needs to happen is investors who go onto the COMEX and take delivery, they need to remove their bars from the COMEX once they've been delivered. If you leave them in the COMEX, those bars can be hypothecated and redelivered, because and no one would know. I mean, they're not going to go let, and I don't care who it is, they're not going to go let even, a big hedge fund guy knock on the door of the vaults to inspect his silver. they, the COMEX wouldn't even let the German delegation who wanted to come over, or the Fed wouldn't let a German delegation, official government people, come over and inspect their gold in the vaults that the Fed was safekeeping for them since World War II, and that's what precipitated Germany's request to have their gold repatriated. But anyway, I'm diverging here. The point is, if you're going to try and squeeze the banks on their precious metal short positions, you gotta squeeze the physical market. And honestly, I mean, I was very happy to see as many people as it seems went and bought silver from places like SD Bullion. Very happy to see that, because that's real money. But you're not going to squeeze them through the retail side of the business, because the mint will just put silver Eagle allocations on
allocation.
On allocation, which I believe they for it, so I could quote it for this, but I think on Friday, I think I saw that, or maybe Saturday, that they had put silver eagles, and that's just because they know they're not going to be able to source enough silver to satisfy retail demand, and that's why the premiums shot up like that.
And now they got that convenient excuse of the redesign of the Silver Eagle, so they got that going for them.
Yeah, that's
we can't meet the demand. We got to redesign the coin.
We've seen that one before. They've used that excuse before.
Now, Dave, so, let's just talk about some of the things that are going on today, because, there was this Bloomberg, right blasted on the front of Bloomberg was, GameStop plunges, silver plunges, and they're trying to group silver like it went GameStop. Silver did not go GameStop. GameStop went from $20 to like $500 at the spike peak of it. And silver went from 27 to 30, but they're trying to make it sound like it just totally went ballistic and parabolic. So one thing that they're doing is mainstream propaganda, that they're relying on the propagandists to help keep the eyes away from silver and draw negative attention to it. So what are some of the other things that are doing? My understanding is there's been a margin hike. So what is a margin hike? What does that do? And what is that designed to do on the COMEX, Dave?
Sure. So I wanted to circle back really quickly, because I just wanted to say, honestly, on a fundamental basis, I think silver's cheap up to $100 an ounce, maybe even higher. But, and I think if you're holding it, hoping for a move back to 50, that's the easiest money to be made. What happens is when the COMEX gets worried that there's going to be a huge influx of people who are looking to game the futures market from the long side, whether it's gold or silver. What happens is they'll hike the margin, so they'll hike the amount of money that's required to put up for a contract. So like with the 5,000 ounce silver contract, the big silver contract. They hiked it yesterday to, I think it was 16,300 per contract. So you have to put that up in order just to buy a contract. And previously it was 14,000, and they've hiked it, I think, a few times during January. So what it does is they try to put the brakes on people from coming in and buying new contracts, because it now all of a sudden requires more capital. And God, when I first started trading silver futures back in the early 2000s, I think you maybe needed $2,500 or something like that to buy a contract. I forget it, maybe 5,000, but I think it was under 5,000 for a while. But at any rate, and then what happens is, so they'll hike the margins, and they usually do that ahead of when they plan on engineering a price hit, which is what we've seen today, a price ambush. And it's easy for them to do that, because the banks go out and they start dumping a lot of contracts on into the COMEX Globex computerized trading system. They basically know where the stop losses are set by the hedge funds, and they go in there to trigger hedge fund stop loss selling, but also for people who are brushing up against their market. I'm not guys with one contract. I'm talking about, big hedge funds that might have 50 or 100 contracts. And when you hike the margin from 14,000 to 16,000 like that, and then go in and slam the market and force selling. You also are forcing selling from hedge funds that may be up against their margin limit. So, and I mean, this is just a wash, rinse, repeat cycle that's been going on in the silver market for the 20 years that I've been involved in this sector.
Yeah, and if there's any hope, the hope is in the bullion dealers, the stackers buying up the supply from the bullion dealers, and they're going on it, trying to get on the bullion dealers, saying, oh, those guys are just jacking up the prices and sticking it to the stackers. But it's not really like that way. I remember in 2015, they were paying people to sell 90% to the bullion dealers, $6 over spot back in 2015, 2016 at the bottom, even though it wasn't the bottom technically in silver. And then, just a couple years ago, the flip of that, I remember personally buying 2 different times. I bought some 90% at spots, and I wasn't even restricted. I could buy as much as I want. And this is just a regular person. This is not me getting some inside deal. This is just me as a person buying at spot. And I also remember buying gold Mexican centenarios. And those are cool because those are 37.5 gram gold coins at spot, Dave. So it goes both ways. So they're trying to make it sound like, oh, this is the bullion dealer's fault. But really, that's where our hope lies, isn't it, Dave? That people are just going to buy up all the volume there.
I mean, it'll help, but like I said, at the margin, the retail investor doesn't drive the market price of silver. I mean, the market price of silver is driven by the countries where there's a lot of like much larger scale silver buying than here in the United States, like India and China. And India is a big importer of physical silver, and it's not like it's not like they go onto the LBMA and buy forwards or onto the LME and buy futures and say, okay, we want delivery, leave the bars in the vault. No, they want the physical gold delivered. And it's also not just refined gold. It's gold. I mean, silver. It's silver that is used in solar programs. Both India and China have massive nationally funded solar rollout programs. So, and that consumes a bunch of silver. So I didn't read it closely, but I saw a report the other day that suggested there's going to be a supply-demand imbalance, and not enough supply to meet demand in silver, going forward for all kinds of reasons. Obviously, you need, silver for any technological application. Electronic vehicles use silver. So and that's a high growth market is the EV market. So at some point, I mean, if the banks could control the price of gold and silver, ad infinitum with paper, then the price of gold and silver would be a lot lower than it is today. So what they try to do is contain the rise. And every time the Fed prints more money, a lot of that money goes into commodities. I mean, we look at the huge commodity bull market we've been in this year, and the same thing applies to silver. Silver was what in mid-March, I think mid-March when everything got hit. I think silver was like around $12.
Yeah, I think it got down like 11.
And now, after yesterday and after the hit today, it's at 26. So that's a pretty good rate of return for real money, right? So, the best the banks can hope to do is just contain the rate at which the price rises, especially as the Fed's going to have to start printing more money, a lot more money.
Very interesting points there, Dave. Now, Dave, so I guess all the short-term forecasts are just thrown out of whack over the last 5 days, are they? I mean, what do you look at right now? Do you look at the technicals? You look at the fundamentals? I mean, it's like me personally, I'm not trading these markets. I haven't placed a trade in several years, but if I was, I would literally be out of this market right now and just sitting back and watching because, I mean, this has been some whipsaw action. And how do you trust the charts right now? How do you trust the fundamentals? How do you trust anything? Are you just kind of stepping back and seeing what's going on? Or like from a trading perspective, what is a trader doing?
Well, I mean, it depends on what you're talking about. If you're just talking about the general meme stocks, I mean, I use charts and technical indicators. Most of these meme stocks are all headed back from whence they came eventually anyway. But like GameStop is going to go back below 10. I just don't know how soon. But with the precious metals market, I'll look at charts, but I've learned after my first 2 years in doing this sector that the technical, because of the enormous amount of intervention, official intervention and manipulation that's in the market, it's very difficult to use charts to try and trade the precious metals sector. So, when I honestly tried to keep as low a profile as possible without looking like I wasn't involved at all. Um, when this whole let's short squeeze the silver market thing started, because I had a feeling, and the jury's still out on how this plays out, but I kind of had a feeling that was probably going to be a short-lived thing, and I'd rather participate in a market where that is driven by fundamentals. And I know silver and gold and mining stocks are fundamentally cheap. So I didn't, unfortunately, I wish I had loaded up on some call options last Friday on stocks like First Majestic, but I just was like, you know what? It may shoot up, and you don't know how long it's going to last or how quickly it's going to retreat. But
yeah, you'd have to gotten out yesterday.
Yeah, and I'm sure a lot of people managed to get out, and hopefully they kept the cash on the sidelines. And I'm sure there's a lot of people that are underwater now on what they bought yesterday.
Yeah,
I know people who bought yesterday because I had people texting me and emailing me out the wazoo asking for silver stock tips. I was like, well, I'm not doing this right now, but if you really want to do it, do these stocks,
Yeah, and there's nothing worse than that feeling of knowing that option's going to expire worthless, because you see the money in that trading account, and then you're like, but in 3 months when that option expires, it's going to be zero. So yeah, that's why I'm just saying, wow, this is just some wild stuff, and I don't know how to make sense out of the next direction, because it's like you said, I think they're trying to push it down, and if they push it down again, it's really going to be this one last royal. I don't want to say it's never going to go under 20 again, because I never use the word never when it comes to talking about gold or silver. But it seems to me like, if they're gonna force it down over the next couple of days, this would be that last flush below $20, and then that would be a major, major back up the truck moment, in my opinion. You have anything you wanted to add on to that?
I don't know that they'll be able to do that, but we'll see. I mean, right now, India is importing physical gold and silver pretty much full out, and they just cut the import duty on gold that Indians have to pay. I think they cut it from like 12.5% down to 10% or something. That's basically ballpark what it was. That'll really stimulate even more Indian gold importing. And China had been dormant in the gold market in terms of visible imports since last February. And over the last couple of weeks, all of a sudden, the Shanghai Gold Exchange has been sporting some nice premiums, indicating that there's more demand for gold than there is coming into the Shanghai Gold Exchange. So that's going to add another kicker to the fundamental underpinnings of the gold and silver market. And the Chinese are also big silver buyers. So, like I said, we don't need Wall Street Bets or Reddit to engineer a short squeeze that's going to be short lived. This market is dirt cheap on its own merits, and that's how I'm treating it. And I actually yesterday, there was a few stocks in my fund that shot up like crazy, and I sold half the position, knowing that if it pulls back, which was my conviction, I could reload even more than what I sold.
That's right, because if you ride it up and ride it back down without doing anything, then all you get is a bunch of heartburn.
Right.
Yeah. So it's interesting because I lost my thought there. It was on your last one, but I can't remember. Well, I'm gonna have to edit this out. But yeah, I can't remember where that thought was going. But anyway, Dave, as we're moving here through winter, like when it comes to that was my point. And I'm not going to edit this out because I'm just going to let it keep rolling. But here's my point. When you're talking about this, Dave, what I'm getting in my head is this vision. And I don't remember if I saw this in a movie or where, but like the dam, right? And like you got a hole in the dam and they stick their finger in it to try and plug the hole. And then it starts coming out of another hole and they stick their finger into that, try and plug that hole. And it's just like, it's a losing proposition, because if they've been able to squash it and get the negative sentiment in the West, then it's still rising in the East. So it's almost like a losing proposition. That was my thought there. Anything to add on that, Dave?
Yeah, the finger in the dam analogy is great, because that's what we saw back in March when all of a sudden, the LBMA and the COMEX were making all this noise about a shortage of gold bars because of refineries being shut down. No, that's BS. There was a shortage of gold bars because they had to, they were worried about the bars that they had hypothecated if you, delivered more than once under paper obligations, but we're sitting in the vault because people started taking their gold out of these vaults. And that's when the LBMA and the COMEX colluded on this accumulated certificate of equity, or whatever they call them. They're the ACE certificates that let you put together. If you put together enough certificates, you can buy an interest in a gold bar in London. And same thing with silver. In fact, the COMEX now, you can't take delivery under the 1,000-ounce contracts. You have to piece together 5,000-ounce contracts for an ACE, and then you can take delivery. And remove the bars. So, that's an example of all of a sudden a hole forming in the dike where these guys are starting to get squeezed on the physical side of the market. And I think they were squeezed on the physical side of the market for most of the summer, and they still may be. Who knows? But at some point, it's going to become blatantly obvious that there's a lot more demand for gold and silver. Well, the bullion banks don't really hold silver, other than the silver that's in SLV that they use at their own discretion. But the gold in the bullion bank vaults in London and New York, at some point they're going to be squeezed out of a lot of their metal, or most of their metal, and that's when the fun's going to really begin.
Very interesting. So, Dave, we've spent the whole day talking about silver today, and that's great because that's right what we'd like to talk about the most is silver. Well, I do anyway. But what's on your radar as we're moving through winter here, Dave? Is there something on your radar the most, like the pandemic, the stimulus, the stock market, something else? Share something that's on your radar right now as we're moving through the end of winter here, Dave.
I'm just waiting for when the Fed's going to be forced to announce more money printing. Right. I'm watching economic activity, the economy, despite the propaganda and all the hope related to the vaccines and all this other stuff. I mean, the average household is struggling. And there's a lot of people, millions of people living in homes where they haven't had to make a payment since last spring. And, when Biden will probably keep kicking the mortgage forbearance programs down the road, but someone has to pay the cost of that. So it's like the dike thing. You put your finger in one of the holes, and all of a sudden a hole springs out somewhere else. And to an extent, the Fed doesn't know where these holes are going to spring out from, and that's why you get market dislocations like we saw in February and March. And that was actually an attempt to find price discovery in the market. That's a good thing. I'm watching to see if we ever get real price discovery back in these markets, and that would entail a massive upward revaluation in the prices of gold and silver, and ultimately the mining stocks, and a massive revaluation lower of the entire stock market.
Mm-hmm, mm-hmm. And if we could just, I was going to ask you the last question, but one more question before that, and just explain for people who don't know, why are mining stocks a leveraged play on silver? Why do people call it like that? Because some people are interested in the mining stocks.
Sure. No, I think if I'm right about gold and silver, the mining stocks are going to follow them up also. Mm-hmm. I mean, the mining stocks are, like the juniors that have resources in the ground, proved resources, gold or silver. I mean, typically that resource will be valued somewhere between maybe $10 and $80 an ounce in the ground, right? Versus the market price right now of 1,839. And so, the cost to get that gold out of the ground is there's some variable costs in there, but it's largely a fixed cost, which is the cost to develop and put in the mine. And so let's say you're a small gold, a small junior, and you're going to convert your mine, your project into a mine, and you've got 1 million ounces in the ground, and your stock is the market cap of your stock is valuing that gold at, say, $50 an ounce, for example. You borrow the money up front, you put in a mine, and all of a sudden, your all-in sustaining cost, which includes your capitalized cost to build the mine and develop the mine, your all-in sustaining cost per ounce may be, say, $1,000 or $1,100 an ounce, right? So you're selling your gold doré for, you know, a little bit of a discount to the spot price, and and you know, so you're, you know, on that basis, you're netting, if your all-in sustaining cost is $1,000 an ounce, you're netting $830 per ounce, right, in the ground for each ounce that you pull out. I mean, that's a huge profit margin ultimately. And to the extent that the price of gold moves higher, you know, let's say it moves from 1839 to 1900, every single dollar price increase that the price of gold gets and that you can get for the gold that you're selling goes directly to your bottom line. And so that's why they're a leverage play on gold and silver.
So there you go. So Dave, speaking of this, you know, tell the viewers and listeners a little bit about either the Short Sellers Journal, the Mining Stock Journal, Investment Research Dynamics, or help viewers understand where they can learn more about what you do, Dave.
Sure. There's two links at the top of my website, investmentresearchdynamics.com, and each one, if you click on it, you'll get a lot more information about what each newsletter entails. The Mining Stock Journal is every other week. And, you know, I give kind of a market summary and a view on what I think is going to happen next, and update the stocks that I cover and recommend. And I invest in almost all of those stocks, not all of them, but most of them. And then, you know, I try to come up with some new ideas. So I would actually like to see the market pull back a bit, because I've got some really good ideas, but they ran up before I could put them in my newsletter. So, and then the Short Sellers Journal is a weekly, and it's, you know, I review what happened in the markets. I review some of the key economic data, and I try to remove the positive media propaganda spin on it reported. And then I usually have a couple short ideas.
So there you go, folks. Get rid of the mainstream propaganda. Don't follow Wall Street bets as your investment advice, and subscribe to the Short Sellers Journal and the Mining Stock Journal. Dave, I'd like to thank you for joining us again on Silver Doctors.
Thanks for having me, Paul. I had a good time.
Should I edit that out? I'm not going to edit that out.